And ultimately, the government doesn't control things. I mean, it likes to nudge things, poke things. Hopefully, the Fed likes to think they can take this price, hold this price level steady in this category and let that one go down. They don't like commodities going up. That kind of inflation is bad. But they don't mind when inflation drives stock prices up because they don't call that inflation. And yet it's nothing but a river flow of money they created. It went somewhere else other than the commodity. Right. Well, that flips. You go back to the late 70s, we were in a recession, stagflation. Fed raising rates dramatically in the late 70s. Commodity prices were exploding. Well, the stock market was a total wasteland. No, they didn't explode as much as gold, but they went up strongly with gold. And I think this time around, they're set to go with the next power leg in gold. I think commodities are set to participate. And they've not always been in sync with gold at all. Sometimes they're quite opposite. In fact, over the last couple of years, gold doubled from 2015 bear market low to 2020, doubled in price. During the same years, Bloomberg went down. When did Bloomberg explode? After gold had peaked and went sideways, Bloomberg then exploded. Okay, totally out of sync. The last couple of years, Bloomberg's drifted down, about a 50% correction back to its bear lows and then gone sideways. Gold's gone up. But I think they're now set technically to hold hands and go together. Why? Primarily because the money will flow out of the massive asset category into that which is perceived to be low risk, higher reward, period. Gold is not some headline chasing market. In fact, if you sell gold or buy gold based on some kind of war news or some kind, the election outcome news, that kind of thing, you're stepping into it, okay? It's likely to blow up in your face. So if you shorted after Trump got elected, you're losing in gold, as much as $100 right now. So you don't do that. Gold moves on broader glacial reasons. And again, look at an M2 chart, go back 50 years and take a look. The gold will oscillate that money growth, but it'll stay in tune with it. They degrade the money, gold's going up. And if they have more excuse to degrade the money because they need to hopefully stop price collapse in this sector or that sector, banks, financials, commercial real estate, they'll do so. When the chief beneficiary is the monetary metal, because it is money. And it's been that way for 3,000 years. We may have forgotten about it, but a lot of the world hasn't. And I think suddenly when the American public, which is not at all bullish on gold, despite its strength year to date, they're not pounding the table. There's no fever in the gold market. That's when you'll see gold start to go more parabolic. Instead of like 3 steps up, 1 step back, it's going to be more like 6, 8 steps up, 2 steps back. And silver will be even more exaggerated. It goes up 4 and drops back 2. It's a bloody market. Yet year to date, silver's up, about as much, if not a little more than the S&P. In fact, 3 days, maybe it'll be up more than the S&P. So it's not a loser from an investor's perspective if you get in at the right spot. That's what I'd be looking for. And I think it is smart money. Obviously, somebody's buying it, and it's not just the Chinese. There are large American investors who've been buying into that sector.
Yeah, it's Rossellas and Costco buyers.
Well, not just them, large investors who are buying into the mining sector. And the mining sector is really a dog. Okay, now you can say that. What a dog. Gold's above the 2020 highs. So it was just 2070, right? Mid 2070 was the summer of 2020. We're now 2,640. Okay.
Gold and silver are more than just shiny metals. They are economic barometers, cultural cornerstones, and arguably the most reliable store of value across centuries. Michael Oliver's insights on the market dynamics remind us why these precious metals retain their allure even in a world increasingly dominated by fiat currencies and speculative assets. Let's revisit a period often forgotten, the late 1970s. The economy was reeling under stagflation, high inflation paired with sluggish economic growth. During this time, the Federal Reserve hiked interest rates dramatically, aiming to curb inflation. The result? Commodity prices, led by gold, surged while the stock market languished. Gold emerged as a safe haven, reflecting its intrinsic value as a hedge against inflation and economic turmoil. Fast forward to today, we see striking parallels. The Federal Reserve is once again attempting to juggle economic growth with rising inflation. And just like the late 70s, gold is beginning to glimmer brighter, signaling a potential shift in investor sentiment. In previous cycles, commodities and gold often moved in tandem, yet not always in sync. Consider the Bloomberg Commodity Index, which experienced a significant downturn while gold doubled in value between 2015 and 2020. This divergence, though intriguing, underscores an essential truth. Gold's trajectory is not solely tied to other commodities. It moves on broader economic and monetary dynamics. However, as Michael Oliver points out, the winds are shifting. Commodities are poised to join gold in its upward march. Why? Because as capital flees overvalued equity markets, it seeks refuge in assets perceived as undervalued or safer. Commodities, long overshadowed, now stand ready to capitalize on this shift alongside gold. The modern financial system has created a massive asset bubble with inflated valuations across tech stocks, real estate, and even speculative cryptocurrencies. This everything bubble, as it's often called, is unsustainable. When it bursts, as history shows it inevitably will, capital will flow to perceived safe havens. Gold, with its 3,000-year track record as real money, is a prime candidate. Interestingly, this shift is not driven by short-term news cycles or geopolitical headlines. Gold's ascent is powered by glacial reasons, as Oliver aptly puts it. These are the slow, inevitable economic forces like inflation, currency debasement, and the erosion of trust in fiat currencies. The M2 money supply chart, for instance, paints a clear picture. As central banks print more money, the value of fiat currencies diminishes, while gold's value grows. Despite gold's strong performance this year, the American public remains largely indifferent. There's no feverish buying spree, no frantic accumulation. This lack of enthusiasm is, paradoxically, a bullish signal. It suggests that gold's rise has been driven by smart money, central banks, institutional investors, and savvy individuals, rather than speculative mania. Once the general public catches on, we may witness a dramatic shift. Gold's steady 3 steps forward, 1 step back pattern could transform into a more parabolic ascent. In such a scenario, silver, often called gold on steroids, is likely to outperform gold in percentage terms due to its higher volatility. Silver has often been overshadowed by its shinier counterpart, but it's a mistake to underestimate its potential. Year to date, silver's performance rivals that of the S&P 500, a feat that should catch any investor's eye. As Oliver notes, silver's movements are exaggerated compared to gold. When gold rises, silver tends to rise faster. When gold falls, silver plummets further. This volatility makes silver an attractive, albeit riskier, investment. For those willing to endure its wild swings, the rewards can be substantial, especially as the gold-to-silver ratio, currently at historically high levels, begins to normalize. Gold mining stocks, represented by indices like GDX, have underperformed physical gold. Despite gold trading well above its 2020 highs, mining stocks remain undervalued. This divergence presents a unique opportunity. Once mainstream investors begin reallocating funds from overvalued tech stocks to undervalued miners, the sector could experience explosive growth. Moreover, many gold mining companies offer dividends, adding another layer of appeal for income-focused investors. As Oliver suggests, it won't take much money flow to propel this sector to new heights.
Meanwhile, the gold miners, using GDX, for example, which is not necessarily the best metric, its high back then was $45. Right now it's trading 34, 35. So yes, it's up year to date, a nice percent. Not as much as gold or silver, by the way. But it's not got a fever in it, that's for sure. And we're arguing that you got to watch that dog sector, because once you break the stock market, there are investors who are not going to go out and buy silver bullion or futures contracts or triple long silver and bullion ETFs or anything like that. They're going to buy stocks. And some of these stocks have decent dividends, by the way. And so they're going to move out of this stock and into these stocks. And they're going to move into that gold mining sector. And it won't take a heck of a lot of money flow to bloat that sector off the page. When suddenly you get public interest in it. I think it could be far more dramatic than anybody can technically project, and far more rapid. Once the stuff starts to unravel that we've been talking about, that will fuel gold. And once it becomes almost the sole good alternative, and people suddenly realize, my gosh, it's been a better place to be actually year to date, and I'm all fevered over this market and wasn't fevered over gold, and yet gold beat them and nobody's pounding the table. Then suddenly it starts to go vertical because the river flow of liquidity. And that's where you want to be. Now, where might gold go? Well, if you go back and since it was legalized, 75, we had a move, went up to $200 in early 75, as soon as we opened trading on the futures, dropped down to 103 by the summer of 76. Okay, summer of 76, to early 1980. Went from 103 to 850. You do the math, eightfold, okay? Go back to 2000. Gold made a reaction low at about 260. Over the next 11 years, it went to 1920, almost an eightfold move. Okay, so when you look at a log scale gold chart and you see these ratio moves, well, if we went up eightfold, it'd be $8,000 gold. And that would be merely replicating the two prior bull markets. She's not pounding the table and saying, oh, we'll do it again. Well, we don't have a do it again situation here. We have fundamentals and dynamics that are far more beneficial for gold and disastrous for other assets that could drive gold a lot further. But I'm not going to project where it could be. When I mentioned $8,000 gold in multiple interviews over the last year, it's not like I'm predicting that. I'm just simply saying if it merely did what it did before, it'd be $8,000 gold. And that wouldn't be off the page. It's hard to come up with a number. I do think, though, it should be speedy. In other words, I think a lot of it could occur if the stock market starts to break in the first quarter coming up and you start to get that money flow. A lot of this could occur during the next year.
Gold's price movements are rarely linear, and its next leg up could be nothing short of spectacular. Historical precedents provide compelling evidence. During the 1970s, gold soared from $103 to $850. A nearly eightfold increase. Between 2000 and 2011, it went from $260 to $1,920, another eightfold leap. If history repeats itself, as Oliver speculates, an eightfold increase from today's prices would put gold at a jaw-dropping $20,000 per ounce. While this number may seem far-fetched, it's essential to understand that such a move wouldn't be unprecedented. It would merely replicate previous bull markets and align with the dramatic currency debasement and global economic instability we're witnessing. The overvaluation in today's stock market cannot be overstated. Metrics like the Buffett indicator, which compares the total stock market valuation to GDP, are flashing red. The current reading, 142% above its long-term average, signals a market teetering on the edge of a bubble. When the bubble bursts, as history shows it inevitably will, capital will flow to perceived safe havens. Gold, with its proven resilience and intrinsic value, is primed to absorb this shift. Moreover, the collapse of speculative bubbles in tech stocks and cryptocurrencies will likely redirect capital into more stable assets. Gold, which has already demonstrated its strength, will benefit immensely. As investors scramble to secure their wealth, the spotlight will shift to precious metals, reinforcing their historical role as the ultimate safe haven. Central banks have been net buyers of gold for over a decade, a trend that shows no signs of slowing. Countries like China, Russia, and India are increasing their gold reserves as a hedge against dollar dependency and geopolitical risks. This steady accumulation by central banks is a vote of confidence in gold's enduring value. Interestingly, large American investors are also quietly entering the gold market. These are not headline-chasing speculators, but calculated players who understand gold's role in portfolio diversification. Their presence underscores a growing recognition of gold's strategic importance in an era of monetary uncertainty. While gold garners most of the attention, silver offers a unique value proposition. Historically, silver has outperformed gold during bull markets. Its lower price point in industrial applications make it accessible to a broader range of investors. Silver's volatility is both a risk and an opportunity. For those with a high risk tolerance, silver's potential for outsized gains is unparalleled. As the gold to silver ratio narrows, currently at historically high levels, silver could deliver exceptional returns. Historically, the ratio has ranged from 15 to 1 to 20 to 1, but today it hovers around 85 to 1:1. This disparity highlights a significant upside potential for silver as it aligns more closely with its historical norms. As capital flows into gold and silver, mining stocks are poised to benefit. These companies offer leverage to rising metal prices, meaning their stock prices tend to increase at a faster rate than the underlying metals. For example, during the last major bull market, mining stocks outperformed physical gold by significant margins, delivering exponential gains to early investors. The current underperformance of mining stocks relative to gold presents a unique buying opportunity. As mainstream investors reallocate funds from overvalued sectors to undervalued mining stocks, the sector could see explosive growth. Moreover, many gold mining companies offer dividends, adding another layer of appeal for income-focused investors. The combination of undervaluation and potential for rapid appreciation makes this sector particularly attractive. One of the most intriguing aspects of gold's potential bull run is the psychological shift that will occur. Today, gold is viewed as a niche asset, primarily held by central banks, institutional investors, and a small group of retail investors. However, as economic conditions deteriorate and inflation erodes purchasing power, the broader public will turn to gold as a safe haven. This shift in sentiment will drive gold prices higher, creating a feedback loop that attracts even more investors. What begins as a trickle of interest could quickly become a flood, pushing gold into uncharted territory. The public's awakening to gold's value will be a key driver of its next bull market. Silver, often referred to as gold's younger sibling, is uniquely positioned to capitalize on the coming wave of investor interest. Its dual role as both a precious and industrial metal makes it particularly compelling. As demand for green technologies like solar panels and electric vehicles grows, so too does the demand for silver. Moreover, silver's historical performance during bull markets cannot be ignored. In the 1970s, silver prices skyrocketed from $1.50 to nearly $50 per ounce, a staggering increase of over 3,000%. While such a dramatic move may not be immediately on the horizon, silver's potential to outperform gold in percentage terms remains a compelling argument for its inclusion in a diversified portfolio. As fiat currencies continue to lose purchasing power, the idea of a return to a gold standard gains traction. While this may seem like a relic of the past, it's worth noting that gold-backed currencies provided economic stability for centuries. A modern gold standard could restore confidence in monetary systems and provide a check against runaway inflation. The mechanics of a gold standard would involve pegging currencies to a fixed quantity of gold, thereby limiting the ability of central banks to print money indiscriminately. While such a system would require significant political will and international cooperation, the ongoing erosion of trust in fiat currencies makes it a possibility worth considering. Geopolitical tensions often serve as catalysts for gold's price movements. Whether it's conflicts in Eastern Europe, trade wars, or shifts in global power dynamics, these events create uncertainty that drives investors towards safe haven assets. Gold's role as a store of value becomes even more critical in such scenarios, reinforcing its importance in a diversified investment strategy. For those considering an investment in gold or silver, timing is crucial. Waiting for the perfect entry point often results in missed opportunities. The current economic environment, characterized by high inflation, geopolitical instability, and overvalued equity markets, provides a compelling case for taking action now. Investors should also consider diversifying their exposure. Physical gold and silver provide the ultimate hedge, but mining stocks offer leverage for those seeking higher returns. ETFs can also be a convenient option for gaining exposure to precious metals, though they lack the tangibility of physical assets. As Michael Oliver eloquently states, gold is not just another asset, it is money. Its value is intrinsic, not derived from the promises of governments or central banks. In a world of economic uncertainty and fiat currency debasement, gold and silver stand as beacons of stability. The coming years could mark the beginning of a new era for precious metals. Whether you're an experienced investor or new to the market, the opportunity is clear. Gold and silver are not just commodities. They are lifelines in an increasingly volatile financial landscape. Start small, but start now. Even a modest allocation to gold and silver can provide significant portfolio protection. Begin with 5 to 10% of your portfolio in physical metals or mining stocks. Diversify across asset classes. Combine physical metals with mining stocks and ETFs to balance risk and reward. Stay informed. Keep an eye on macroeconomic trends, central bank policies, and geopolitical developments that could impact precious metals markets. Think long-term. Gold and silver are not get-rich-quick schemes. They are stores of value designed to preserve wealth over time. Consider professional guidance. Consult with financial advisors who specialize in precious metals to tailor an investment strategy that aligns with your goals. Gold and silver are more than just investments. They are safeguards against economic turbulence. As the world grapples with inflation, geopolitical tensions, and the limitations of fiat currencies, These timeless metals offer a path to financial resilience. The time to act is now, before the broader market wakes up to the value of gold and silver. Embrace the opportunity and secure your financial future in an uncertain world.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.